So what I'm going to do in my presentation is to focus specifically on how we can use monetary and financial policies in order to support the financing of the green transition in the EU. And there have been a lot of debates about that because many central banks, for instance, have started using some tools in order to analyze climate risks. For instance, the ECB has conducted many stress testing exercises about climate. The Bank of England has done the same. And there's a lot of discussion about what central banks in general can do in order to support the transition. There's also a very interesting discussion about the role of financial regulation and whether financial regulation can be used in order to change the direction of investment, financial investment. So this is what I'm going to talk about in my presentation. And let me say from the beginning that, in my view, if we want to achieve the transition quickly, we really need to use a lot of different tools, and we need to have a kind of a policy mix perspective. So fiscal, industrial policies, regulation policies, in my view, are very important. But the question is how to support these policies by changing the way that we organize policies related to the financial system. Because the reality is that, first of all, we need to finance a lot of investment. Second, the financial system is really powerful nowadays. So we need to find a way to change the way that the financial system works, because it has supported the climate change in a very negative way in the past, and it continues to do so. The other thing that I would like to highlight is that, as I also mentioned before, in my view, it's very important to start talking more seriously about adaptation, but also about the financing of losses and damages, because we are not 20 years ago. We are already seeing the effects of climate change around the world, and I think we need a serious discussion about how we are going to finance climate adaptation. Now, a quick point about what is the problem with the financial system. I have here a graph which summarizes somehow the problem, in the sense that this graph shows the financing of fossil fuel activities that has been provided by several European banks over the last years. And it is now very well documented that, of course, many banks around the world, but including the EU, have supported investments that are very bad for climate. And the problem is that every year we have the publication of this data about the financing of fossil fuels by banks, and we don't see any improvement. So it seems that banks are not so much willing to change this fact. They are willing to do more green stuff, and they have provided green finance. But if we don't also reduce the financing of fossil fuels, we are not addressing the problem. Another thing that I would like to highlight is related to central banks. And in the past, we saw a lot of quantitative easing programs. There were many refinancing operations, interventions from central banks in the context of the global financial crisis and COVID-19. And many of these programs continue to exist. And there have been many studies that have shown very clearly that what happens is that through these programs, central banks disproportionately supported carbon-intensive companies. Why was that the case? If you think, for example, about the bond market, I mean, the bond market received a lot of support from central banks, for example, through quantitative easing programs. What happens in the bond market is that we have a lot of carbon-intensive companies that are usually big and issue a lot of bonds, having a high representation in this market. So when central banks decided to intervene in a kind of a market neutral way, so they wanted to keep the market shares as they were in the bond market, basically they supported quite a lot many big carbon intensive companies. And this means that whenever central banks intervene to the economy, they don't do that in a way that is neutral from a climate perspective. And this is why we had in the past discussed about the carbon bias. There have been studies about the Bank of England programs, the ECB programs. We also published quite a lot on that. And I mean, central banks accept this. They accept that their programs support the carbon intensive companies much more than less carbon intensive sectors. Now, the other thing that I would like to highlight before I talk about specific tools that can be used to support the green transition is that, in my view, we need to have this combination of carrots and sticks. I mean, Victor talked about that before. And why is that important? Because if, for instance, we have a way to reduce interest rates for green investments and to have more green finance, then this might incentivize some companies to do more green stuff. But the problem is that we have some very profitable companies in carbon intensive sectors. And even if we give them some incentives to change their business model, if we don't have some sticks, which could be regulation or higher interest rates, in order to make them understand that they cannot continue doing dirty stuff, we might not see a quick transition, right? Because it might still be profitable for some companies to use their fossil reserves instead of making a very complicated transition if we don't have some very specific regulation or very specific sticks in general that are going to make them change the way that they produce stuff. So I think it's very important to have that in our mind, and I'm going to connect this with what the ECB has done recently in order to highlight that sticks are quite important given that we don't have so much time to act on climate. Now, I'll spend the rest of my presentation to present some of the tools that have been discussed in the context of supporting the green transition from a financial and monetary perspective. So on the slide, I have three tools that can be recalibrated in order to support the climate transition. And the first one is the so-called collateral framework. So what the central banks do, I mean, not all central banks, but many central banks around the world, including the ECB, is that they identify a very big list of financial assets that central commercial banks, can use as collateral when they want to get access to central bank liquidity. So, for example, if a commercial bank wants to get a loan from a central bank, they might need to have a government bond that is considered to be of high quality. They post this as collateral, which means that if something happens and the bank cannot repay debt, the central bank can use this bond, sell it, and recover some of the financial losses. The types of financial assets that can be used as collateral are specified by the ECB. So the ECB publishes a list of financial assets, and only these financial assets can be used as collateral. If commercial banks don't have enough of these financial assets, they have problems in terms of having access to central bank liquidity. Now, these assets are mostly government public assets, but they are also private assets. So you can find a lot of corporate bonds in the ECB collateral framework. And it's not a surprise if I tell you that many of these bonds are basically bonds that are issued by carbon-intensive companies. We have a lot of fossil fuel companies in the ECB collateral framework. So if we're going to change that, if we're going to have a collateral framework that is greener, what can we do? There are two things that we can do. One is related to the so-called haircut. What is a haircut? If you have, let's say, a bond that has a value equal to 100 euros, if the haircut is 10%, you can use this in order to get liquidity equal to 90 euros. If the haircut is 50%, you can get only 50 euros as liquidity. So the higher the haircut, the less you can get liquidity from the central bank. What we can easily do is to say that the haircuts for carbon-intensive bonds become higher, the haircuts for greener bonds become lower. And this changes how desirable these assets are from commercial banks and, at the end of the day, in the financial markets more broadly. Because there have been many studies that show that whatever is included in the collateral framework and has a lower haircut has a higher demand in the private financial markets. So central banks can have an indirect impact on what happens in the financial markets, and this can affect the cost of borrowing. Another thing that we can do in the central bank collateral frameworks is to exclude some assets. So we could easily say that we have companies that do not deliver from a transition perspective. they still have a lot of emissions, they have projects about fossil fuel expansion. These companies should not be included in the collateral framework. So exclusion is also a possibility. Now, this is one tool, the collateral framework. Let me say that it's quite powerful because it's a permanent measure. It's a permanent tool. It is used always. It doesn't have to do with the cycle of the economy if we are in expansion or in a recession. And to give you an example of how powerful the collateral framework is, you might know that in 2015, when we had the Greek crisis, the reason why there was a bank run increase is because the ECB refused to provide liquidity to Greek commercial banks using as collateral Greek government bonds. So Greek government bonds were not accepted as collateral. As a result, commercial banks in Greece couldn't get access to ECB liquidity. As a result of that, we had bank runs. So it can be quite powerful. Now, key programs, asset purchases. There are ways to change this in the direction of supporting the green transition. We have the central banks in general have bought a lot of public and private securities. So what you can do is to have criteria about climate criteria about which private bonds look better based on their issues than other bonds. And I'm going to say something more about that in a bit. And then you can have a reallocation of the purchases from bonds that are relatively dirty to bonds that are relatively green. And again, you can have a decision that some specific bonds which are very carbon intensive should not be included in the asset purchases. This can be extended to public bonds. And I have a slide where I saw that green sovereign bonds overall have increased. Their issuance has increased over the last years. So what can be done is for these green sovereign bonds to be bought by central banks in order to support the green projects, the green public projects. And by doing that, basically the interest rate on these bonds can go down. So this is a second tool. And the third one is refinancing operations. So this refers, for example, to TLTROs that the ECB has used. So longer-term refinancing operations are quite important in terms of providing a direction about credit, because what the ECB did at some point was tell commercial banks that if you provide more credit to the economy, you will get access to central bank liquidity at lower interest rates. So in principle, this can incentivize some specific behavior from banks. So greening refinancing operations means that you introduce some climate criteria, and basically you say to banks that if you provide more green credit to the economy, you will get access to central bank liquidity at lower interest rates. If you do the opposite, you might need to pay a higher interest rate. Now, this policy has received a lot of attention after the ECB started increasing interest rates. Why? Because we know very well that renewable energy projects are very capital intensive, so they require a lot of finance initially, and then the costs, the variable costs are very low, but they require this initial amount of finance, so they are very much sensitive to interest rates compared to more traditional carbon intensive projects. So with the increase in the interest rate, we have seen that many of these projects have been affected. So it becomes less profitable to invest in renewables in an environment of high interest rates. So many people have suggested that we need to have different interest rates. So if commercial banks support green companies, then the interest rate for them can be lower, and in order for them to pass this on to the loans that they provide to their borrowers. So by using refinancing operations, we have basically 2 or 3 different interest rates, and we don't have that a very high interest rate applies also to green projects which require quite low interest rates not to be profitable. So these are 3 general tools. Let me say that one of these tools, the asset purchases, the greening of asset purchases, has been used by the ECB, and there has been a lot of discussion about that. So about 2 years ago, the ECB decided that it would make sense to introduce some climate criteria in their corporate bond purchases. The way that they justified that was to say that the ECB has a primary target and a secondary target. The primary target is inflation, so everything needs to be driven by that. But as part of the secondary mandate of the ECB, it's necessary for ECB to support the targets of the EU, so the targets of the governments in the EU. And one of the targets is net zero by 2050. So the argument was that as long as it's possible to introduce climate criteria into the quantitative easing program without undermining the price stability target, it's perfectly fine for the ECB to do that. This was one of the key arguments that was used. And what the ECB decided to do was to measure the climate performance of companies based on different criteria. I'm going to say something about that in a bit. And based on this climate criteria, they decided to reallocate their reinvestments. They focused only on reinvestments to greener projects. So to companies in particular that had a better climate profile. So for all the new reinvestments, they tried to have this tilting perspective. So they provided more, they bought more bonds issued by companies with a better climate performance. Now, the problem was that they decided to focus only on reinvestments, and reinvestments were a very small proportion of the total holdings of the ECB, about less than 10% actually. So as you can imagine, this didn't have a very significant impact. The other problem was that the climate scoring of the ECB, in my view, was not strict enough, and it created a lot of space for some carbon-intensive companies to get relatively good climate scores. And the other problem was that the ECB didn't want to start selling any carbon-intensive bonds. So they focused only on reinvestments. They didn't want to say, now we're going to sell some bonds of fossil fuel companies that do not perform well from a climate perspective. And as a result of that, the impact was very small. And in the graph that I have on the slide, this is from a report that we wrote with Greenpeace. You can see that what happens is that, in particular, after 2023, July 2023, when reinvestments stopped for the vast majority of the key programs of the ECB, what we expect to happen is that there will be a decline in the stock of bonds that are held by the ECB if nothing else happens, and the proportion of dirty bonds and green bonds does not actually change because the ECB didn't want to apply this to stocks as well. So it was very interesting that they did that. They developed a quite interesting climate scoring framework, but they were not ambitious enough in order to do something that could have an impact. Now, let me say something about how the ECB developed the climate scoring framework. In the discussions about climate finance, in most cases, we talk about taxonomies of green activities and taxonomies of dirty activities. So what you can do if you're going to evaluate companies is to classify them based on the main activities. And this is straightforward because we have now classifications of activities and we know which activities tend to be more dirty than others. There is a challenge with the so-called transition activities, so especially activities in the manufacturing sector, whereby the carbon intensity is now very high, but it's possible to use technologies in order to reduce carbon intensity. This is why we need at the same time to use indicators about emissions in order to have information about what progress companies make in terms of reducing their emissions. So nowadays you can easily find data for listed companies related to carbon intensity, so emissions per revenue. You can look at what has been the decarbonization rate in the past, and now many companies also have targets with respect to how much they're going to decarbonize in the future. So what the ECB did was to use all this information and to develop some indicators in order to classify companies based on how well they perform from a carbon perspective. And you can combine information about the types of activities with the carbon emissions data, and you can get some interesting scorings. And this is what the Bank of England did as well. The question is how strict you are in this scoring, and this is where I think the ECB didn't want to be extremely ambitious, but I think it was still very useful that they developed this framework, because the same framework can be used in order to decarbonize other parts of the financial system. And this can also be used in general for public policies. I mean, when, for instance, we have conditionalities, we can have conditionalities about carbon emissions and how much companies make progress in terms of reducing these emissions. So I think it's quite interesting to look at this also from a technical perspective. Now, I mentioned before that we have an increase in the issuance of green sovereign bonds. So we have already a lot of green corporate bonds. And the ECB actually bought a lot of these bonds during the period that they implemented this Green Key program. But I think what is interesting is that now we are seeing an increase in the issuance of green sovereign bonds. And green sovereign bonds can be bonds about mitigation or even adaptation. It would be straightforward for the ECB to say that they would have a preference for these bonds, both in terms of their quantitative easing purchases, but also in collateral frameworks, because this would create a demand for these bonds. It could reduce the interest rates and would incentivize governments around Europe to basically use this as an instrument to finance some public projects. Of course, there's this discussion about how much the ECB then supports directly governments. But I mean, at the same time, in any case, government bonds are bought by the ECB. So I don't think it would be so complicated for the ECB to make a commitment based on what I said before about their secondary mandate. Now, let me turn to financial regulation and supervision. Here we have discussions about capital requirements, about credit guidance, but also discussions about financial disclosures. So there is a very big debate about whether we can change capital requirements in order to incentivize specific types of financial investment. And there is, for instance, a discussion about having very high capital requirements for fossil fuels, for loans related to fossil fuel investments. The idea is that in any case, these investments are very bad from a climate perspective, but they're also quite risky for banks in the case in which we have a transition. So many people have argued that we really need to increase capital requirements for this. But there's also the argument that if we do that, we can also reduce capital requirements for some green loans, because this can incentivize and create more space in banks to support the green transition. So this is one way to adjust financial regulation. Then in Europe, we really don't have discussions about credit guidance. I mean, we don't have discussions, in mainstream policy thinking about credit guidance. But just to say that I work, for instance, with the Reserve Bank of India, and in India they have credit guidance, and they are very happy to use this in order to support renewables. They have already renewables in their credit guidance framework. And if we are talking about industrial policy, we know that in the past, financial tools have been used, like credit guidance, have been used in combination with industrial policies in order to make sure that there will be finance for specific sectors, but also in order to make sure that the banking sector does not waste resources by supporting those sectors that are not good for development. So Europe, in principle, could get back to this discussion. Right now, I don't think that this is going to happen, because nobody in financial supervision and regulation would be so happy to talk about credit controls. But I think it's a tool that can be very useful if we're going to make the transition quickly. And finally, we have disclosures. I mean, EU policymakers would be more open to this idea that we can have information about climate performance that is shared with investors. And there's also discussion about transition plans, whereby banks and companies specify how exactly they're going to make the transition. And these transition plans could be public, and this would allow financial investors to decide which companies seem to perform better than others. I think this can be done, and there's already some progress in terms of this. The problem is that if you just have disclosures, it doesn't mean that there will be an implication if you don't have a very good transition plan. I mean, perhaps the markets are going to react to this, but this might take some time. But in any case, I think it's useful to work on disclosures as well, because the more we disclose, have a disclosure about climate data, the easier it is to evaluate companies, and the easier it is for policy tools to be calibrated in order to support the green transition. A quick comment about these tools is that so far, if you ask people in BIS, for instance, or in financial supervisory authorities around the EU, the reaction to these ideas is that financial regulation is about prudential issues. So it's about protecting the financial system from risks. And my view is that we have a problem right now because there is too much emphasis on micro risk. Even though the global financial crisis made it clear that we need to look at the risks from a macro perspective, I think we still have the problem that there's a lot of micro thinking in the way that financial supervisors think about the climate problem. My view is that in order to understand these tools, we need to have a more systemic perspective, and we need to use this concept of double materiality, which basically says that it's not only that the financial system is exposed to climate risks, it's also that the financial system contributes to climate risk because they continue to finance activities that lead to more emissions. So we need to look at this from a systemic perspective. And if we take measures that are going to make the EU financial system greener, first of all, this would mean that this financial system will be more resilient to any changes in climate policies, not only in the EU, but also globally. Second, if we have that there will be less credit for carbon intensive activities, at the end of the day, EU emissions will go down. EU emissions are quite important from a global perspective. I mean, EU is a big region, and this can have implications for global warming. So everyone knows that if we have less global warming, the financial system around the world will be more stable. So there is, from a macro perspective, there is a clear argument in favor of doing something to reduce emissions, the financing of emissions. And adaptation is very important. Why? Because if we finance climate adaptation, it will be easier. I mean, it's complicated, but if we have ways through which some finance is provided for adaptation, it means that the local communities can be more resilient to climate change. And again, at the end of the day, this will be good for the financial sector. So what I'm saying is that even from a very strict financial supervision perspective, it makes sense to do something that is considered to be very radical, because it will be good for the stability of the whole financial system. I think right now regulators that work on climate in the EU, they really have a very micro focus, and I don't think that this is what we need right now. So just to conclude, I try to describe some tools. These are just some examples that we can use in order to support the transition from a financial perspective. In my view, if we're going to use these tools, first of all, they should be in combination with many other policies. So we need a policy mix mindset. The problem with many of these tools is that they move beyond the current conventional thinking in central banking and financial supervision. So I think we really need to change that if we want to make some progress with respect to climate. We need to have a more system-based economic thinking that doesn't focus so much on micro. And I would also like to say, because I work a lot with central banks in Asia and Latin America, when we implement policies in the EU, we always need to take into account climate justice, because, we are responsible for a significant amount of emissions in the past. And I think one problem that we have right now is that even when we try to support the green transition, sometimes we don't take into account, for example, in the case of green minerals, I know that you discussed this in the previous sessions, there is a problem of green extractivism. Many communities in the global south and many ecosystems in the global south have been affected in a negative way from the extraction of green minerals. So we need to take this into account and try to find ways not to make a transition that is going to be bad for the global south, because we have a climate justice responsibility. But this is just to have a kind of a more global perspective on that, because I think sometimes we forget about this. But thank you so much, and I very much look forward to your comments and questions.